The stages of a business cycle. To work out where an economy is moving, economists look at a range of trends in business activity. An expansion, for example, will see a huge upturn in the need for goods and services, which results in 1. Inflation rising. 2. Overall production increasing. Production increases lead to more jobs and lower unemployment rates, inventories dropping, stock markets rising, property values rising, and GDP increase. A peak's characteristics are marked by a decrease in the growth rate of GDP, hiring rates slowing down, consumer spending and business investment slow down, and a peak in the inflation rate. When there is a contraction, the following will happen. A rise in bond defaults, rise in bankruptcies, unemployment rates go up, those that do have jobs work fewer hours, a significant lowering in consumer spending, home construction slows, business investments drop, stock markets drop, and a decrease in the rate of inflation. Less consumer spending means stock inventories grow and a negative growth rate for the GDP. A trough's characteristics include a change from negative to positive in the growth rate of the GDP, high employment rates, more overtime for workers, spending on consumer goods and housing goes up, inflation is moderate and might start to drop. Cyclical industries. Cyclical industries are heavily affected by both business cycles and inflation trends. Typically, these industries produce durable goods and raw materials. Take, for example, the automobile industry, heavy machinery manufacturers, and raw material producers. These are excellent examples of cyclical industries. In times of recession, however, the demand for the goods cyclical industries produce decreases. They won't invest in any new capital goods either. Certain industries like gold mining are counter-cyclical. This means when the economy begins to falter, they start to excel. Growth industries. During their lifetime, most industries will pass through 4 distinct phases. Most industries go through 4 phases during their lifetime: introduction, growth, maturity, and decline. For it to reach the growth phase, then when compared to the economy, it will be growing at a rate that's much faster. And there are numerous reasons for this. An excellent example of recent growth industries includes artificial intelligence and EVs, for example. Generally, however, an industry that is in the growth phases will look to expand further and reinvest the earnings they make into that. This means they aren't that great for investors who are wanting to earn income from dividend payouts. Defensive industries. During normal business cycles, defensive industries are the least affected. A defensive industry is one that produces non-durable consumer goods, which include energy, food, pharmaceuticals, tobacco, and others. No matter where in the business cycle the industry finds itself, there is always a steady need for these goods from consumers. That means stocks from these industries lose less value than others during a recession. That also means that their value increases less than stocks linked to other industries during an expansion. But for investors looking for less risk, buying stocks in a company that's in a defensive industry makes sense. For those that use a sector rotation strategy, moving their investments to a defensive industry makes sense when the business cycle moves towards contraction. If you like this video, hit the like button and subscribe to our channel for more informative videos.